Hello and welcome. This is 10 Minute Stock Pitch. Today I'm going to be doing an intro. We're going to be going over Apple, and I'm going to be showing you kind of basically roughly what I'm going to be doing. Most of my stocks are going to be as well known, but I'm going to go over a couple well known ones. We're going to be doing Apple first here, and then I'll be doing Tesla as well, just so you get an idea of kind of how I think about things. And, it's kind of tough to figure out how I perceive different companies, especially with a company you don't know. So I want to do a couple well-known companies first. Also, as I'm kind of introducing the concept to people, it doesn't need to be a company that is so unknown to you. You can kind of get an idea of what I'm doing. So in this 10-minute stock pitch, the basic idea is going to be, hit some of the high notes over the company, and then look into, maybe I'll probably be going over what I kind of research I did and research I didn't, so you can have a better idea of how you yourself can kind of look a little bit further. And then also, I'm going to be giving kind of a not interesting, interesting, or very interesting score. Um, if it's a skip, I'm probably not going to bother recording it, unless somebody really wants me to do one, I'll do one, and maybe there'll be some skips in there. But for the most part, I'll probably put not interesting, interesting to very interesting. Okay, so let's get started with Apple here. The actual rating criteria that I'm going to be using here, I'm going to be using free cash flow plus growth. These are primarily trailing numbers. I'm not using my opinion on what I think growth was going to be. And then we kind of have a total rating here. This is going to be kind of business economics mixed with management. So you can see that's a 68% here. These are all numbers 1 out of 10, 10 being the best, and then each section is 25% of the score. So 25% of the score is management, 25% of the score is whether it's cheap or not, 25% of the score is it's kind of moat. Essentially, what that means to me is how easy it is for another company to take business from them, and roughly how competitive the actual industry is. And then business is going to be business economics, and then they'll also somewhat take into an account. It's not just so simple as like gross margin or something, right? Business score will also take into account all of their lines of business, how important they are, whether or not it's a good business. Does the company have a brand name? Is this a new venture? Is this an old venture? Right? It'll have a lot of things like that in there. So that's kind of roughly what the business score equates to there. And I'll go over each one of these categories individually on the companies. And then, so the free cash flow plus growth. This is a free cash flow number. That's an average of the current year's free cash flow yield. So this is free cash flow per share divided by the current price. So if you owned this business outright, this would be the yearly cash return you could get by owning the business. And then you can see here, I have free cash flow yield average. This is going to be the 5-year average of that free cash flow yield that you would get if you own the entire business. Okay. Next number that we're going to be averaging two together is growth. So this is current year's growth. So this would be last year's growth, the growth from last year to this year, this last year that they published, right? And then this is the average 5-year growth in earnings. So these will typically all be earnings. If the company doesn't have earnings, I may have to get a little bit creative on this one, but I'll have to use whatever's most reasonable. So you can see when we do Tesla, there's kind of an issue where this is high, and so sometimes I may just actually use the growth numbers. But there's going to be times where there's like kind of outlier periods because either the company didn't have actual earnings, so the growth rates look really crazy, or there was kind of a one-time event, unrelated to the business in the long run, where they may have had a bad year of earnings or whatever. So hopefully, I can capture some of that and kind of explain to you when that looks like it's pretty out of whack, and we can go from there. So, but these are just to get kind of a general estimate using past and actual figures. Um, you know, when you actually kind of do the research on the business yourself, future growth matters a lot more than these trailing numbers. So you always want to take that into account. I don't When I put this here, I'm not trying to say you're going to earn a 13.48% return over the next 5 years. I honestly, I'm not going to know that with all the businesses that I talked to you about. But this is a good idea of what it used to be, and hopefully maybe close to something that you'll see in the future. Okay, because honestly, these things, and then your actual research of what the future environment of the business is going to matter a lot more. So with Apple here, I'm going to go into why I gave it these ratings 1 out of 10 here. We'll go individually, and that'll be all. So the business, I gave 8 out of 10. The businesses that Apple engages in, it's kind of tough to go over each one individually and talk about them because they do a lot of stuff. It's a big, well-known brand, so just that alone is pretty good business, because everybody knows them. When they make a new product, people line up to get it. So they have a pretty good brand name, pretty well known, great marketing strategy, and a lot of their products work together, right? So when you get an iPhone, you want a Apple computer, you want the Apple earbuds, you want the Apple Watch, right? So they really do a good job of melding all their products together, so that they can kind of like cross sell amongst their clientele as much as possible. So that's one of the reasons the business has an 8. It also has an 8. Gross margins are pretty high here. You can see they're 44%, and they've just gone up over time, which shows that when management is investing money into the business for growth, they are tending to get higher gross margin products, which in the end can typically lead to better profit. So that's a good thing to see, and you can see there's not massive negative moves here when you go year to year, looking at gross margin. I could pull out and we can go a little bit farther back because this company's been around a while, but we're just kind of speaking general for this one. So that's why they got an 8 out of 10. As far as like the negative reasons why they didn't get a 10, I don't know exactly what they're spending on for R&D initiatives, but they're in a place where they're such a large company now, to assume that their R&D initiatives are going to make like massive impacts to to top line, is kind of difficult. So that's why I pulled back on maybe a higher 9 or 10 rating here. Additionally to that, they do have competitors. There is a little bit of competition for their business environment, meaning they have to hire expensive employees. Right at Apple, you can't just have most of your people be, anybody could work there kind of thing. You know what I mean? You do need expensive talent. Retaining and keeping them interested and keeping them paid is expensive, and that can make it a tough business. Okay, so moving on to the moat here. I touched about part of this briefly. I did say that they do have competitors, but one of the reasons I gave it a moat is because they have such a strong brand name, and I may have been generous here with a 9, but they have such a strong brand name, and they cross-sell so much into their actual lines of business. I gave this a 9. They only have maybe 3 or 4 realistic competitors. But it is difficult once people get into the Apple thing. It is difficult for them to want to switch and cross devices over to Microsoft or Samsung or Hawaii or whatever. If that's how you pronounce that in China. So that's one of the reasons they got high marks on the moat. And they do have a bunch of stuff that they make new product lines and different things that they're usually first to market, and they work really hard to make sure that when they develop a product, it's unique and it's not something that you're going to see, a lot of out there. They try to be first to market, or they try to have a really unique twist on something, and all of their products work and intertwine with their other products. So it's much less likely that somebody is going to use somebody else's, smartwatch or whatever, if they already have Apple stuff. So that's why I give them a 9. Probably a little high there. I may have been a bit generous, but I just kind of did this pretty quick here. So cheapness. This company is not cheap. Um, you know, uh, PE ratio of 33. So it's 33. If you bought this whole company, 33 years before you get your money back. It's not super exciting. Trading at 9 times sales. That's really high. Free cash flows 33, which is about the same as earnings. And then 26 times EBITDA, 28 times EBIT, 20.7 times free cash income. So yeah, not exactly cheap by any means, and because growth isn't high double digits, 15 or so percent on your free cash flow plus growth, um, you know uh, you're not going to be seeing any like amazing 50% of your returns on this anytime soon. And you also have to take into account, you know, it's such a large company. It's just going to be difficult for them to, to really grow into anything to see these numbers look cheap anytime soon. Again, that's my opinion. I didn't go into like what they're doing in R&D stuff. So if you're actually looking into this company, you'll definitely want to look into what they are doing in the R&D department and could the future look like for some of those things. So we move on to management here. You'll see one of the reasons I gave them a 7.5, since we're talking about R&D. R&D as a percentage of total revenue has creeped up a lot. I want to say, I can do the numbers really quick, but 6 divided by 182, so that's 3%. And now it's 30. Okay. No, it's not that much different. But it went up to about like 8% of revenue here. So it would be interesting to understand what their R&D projects look like, what they're planning on, and what those could possibly mean for the company. Because it's already a pretty big company, so spending almost 8% on R&D is relatively high, but they are technology companies, so it would be interesting to see what those look like and what you think. What do you think those could mean for the company looking forward? Okay, so other reasons I didn't give management a 10. I took off some points because so they are paying down shares here, which is a good thing to see. Looking at maybe 3 to 4% a year, highest was 7 recently. Your actual tangible book value is decreasing a lot here. As you can see, I think there's a lot in the book value. Yeah, price to book value is 51, right? So you're kind of ruining a lot of tangible equity, and maybe that's a little bit balanced out by the fact that they are buying back some shares, and then they're also giving some dividends. This is, you can round up to $1 dividend for a $200 stock. It's not anything awesome, but it is something to look at and keep an idea on. Tangible book value per share is almost flat here, so flat to decreasing over the last almost 10 years. So that's something just to kind of keep an eye on. And if you're going to want to own this company for the long run, the capital allocation is probably more important than a lot of the things, because they're a stable, well-known business. They can afford to make some mistakes and still do well. But it looks like the actual equity of the company is declining significantly, while your book value isn't increasing that much, and you're getting this, 2 to 4% on share count reduction, which can translate to returns in the future. But it's nothing really exciting and nothing that I would say like, okay, management's capital allocation strategy is doing great. Again, as I said, I don't know their current R&D efforts and what those could look like for the company. So this is going to be a difficult one to judge just kind of quickly and off the top here. So anyways, that's why I gave it the interesting rating. Interesting can mean, um, you know, not super exciting right now, but could be if the price drops a lot. Um, if we hit a recession or anything, and all stocks kind of go down in general, it could be interesting. Or if you do some good research on what their R&D is, or maybe one of their competitors is not doing so well, and looking to exit the business, it could start to get pushed into the very interesting category. Okay, so that's Apple. Hopefully that gives you kind of an idea of what I'm going to be doing in these stock pitches. And yeah, thank you very much for watching, and I'll see you around.